Imagine a $3.5 billion company, QXO, launching a hostile takeover, not by secret backroom deals, but with a public offer, specifically targeting another firm, RXO. This isn't your usual corporate merger, it's a high-stakes, public battle unfolding right now in 2026. The QXO board just confirmed their proposal. $1.75 billion in cash and 60 million shares of QXO stock for every share of RXO. Think about the implications for investors. When Elon Musk made his play for Twitter, or when Broadcom went after VMware, it created massive volatility. This QXO-RXO showdown is shaping up to be just as dramatic, if not more, for the logistics sector. RXO stock, trading around $20 just weeks ago, shot up 17% on the news. This isn't just a corporate squabble, it's a masterclass in how these multi-billion-dollar maneuvers directly impact your portfolio. We're going to break down exactly what happened, why, and what history tells us about how these hostile bids play out. Today, we're diving into a fascinating corner of the financial world. The hostile takeover. Not just any takeover, though. We're talking about a multi-billion-dollar fight for control that's currently unfolding and illustrates some of the most cutthroat strategies in corporate finance. Earlier this month, a company called QXO, led by industry titan Brad Jacobs, made an audacious, unsolicited offer to acquire the logistics giant RXO. Now, here's the kicker. Brad Jacobs actually founded RXO years ago, spun it off, and now wants it back. The initial offer, a $1 billion all-stock proposal, was instantly rejected by RXO's board. Just a few days later, QXO sweetened the pot, upping their bid to an eye-watering $1.2 billion, or $20.75 per share, representing a 22% premium to RXO's closing price before the offer. This isn't just business as usual, it's a high-stakes chess match with some of the biggest names in the logistics sector. RXO's board, led by CEO Drew Wilkerson, believes QXO's latest offer still undervalues their company, saying it does not reflect RXO's intrinsic value or its compelling long-term prospects. QXO, meanwhile, is determined, stating they believe a combination would create a leading diversified multimodal transportation platform with an estimated $10 billion in revenue. What makes this story particularly relevant right now, beyond the sheer scale of the money involved, is how it spotlights a critical aspect of market dynamics. Hostile takeovers, while rare, often signal deeper currents in an industry, exposing perceived undervaluation or opportunities for synergistic growth that the market might be missing. We're seeing a highly active period for mergers and acquisitions right now, with companies looking to consolidate power and efficiency. The lesson here is that market forces, and the players driving them, are always looking for ways to create value, sometimes in the most aggressive ways imaginable. This isn't just about two companies, it's about the future of a massive industry. Now, to truly understand the mechanics of what QXO is attempting here, it helps to look at the playbook for a hostile takeover. This whole situation brings us face to face with a familiar name for anyone who's watched the logistics industry. Bradley Jacobs. Jacobs isn't just a familiar name, he's a true logistics kingpin, famous for building XPO Logistics, ticker symbol XPO, from practically nothing, a $150 million market cap in 2011, into a multi-billion-dollar enterprise with over $12 billion in annual revenue by 2020. His signature move? A masterclass in serial acquisitions, scooping up over 17 smaller companies like Conway Incorporated for $3 billion and Norbert Dentressangle for $3.5 billion, integrating them swiftly, all while strategically leveraging an asset-light model where possible. We saw this strategy pay off massively with XPO, and then again when he ingeniously spun off QXO Logistics, ticker QXO, specializing in contract logistics, and RXO, ticker RXO, focusing on brokered transportation into independent, thriving companies, unlocking significant shareholder value. But in early 2023, something shifted. Jacobs sold his remaining 2.3 million shares in XPO for a cool $150 million, a move that signaled a definitive end to his direct involvement and left many in the industry wondering what his next act would be. Well, meet QXO. QXO was his new acquisition vehicle, explicitly designed to acquire and integrate multiple businesses, once again, in the logistics sector, with a particular focus on the supply chain services market. This isn't just some small startup. QXO is backed by immense financial muscle from leading private equity firm Apollo Global Management, giving them a formidable war chest of several $1 billion for future deals, potentially upwards of $4 to $5 billion. What this means for someone looking at these developments is that a highly experienced, well-funded player with a proven track record of creating immense value is back on the field, using a strategy that has repeatedly delivered. This time, their sights are squarely set on RXO, the company he helped build and then spin off, making this a fascinating and potentially lucrative full-circle play. Now, let's get into the specifics of this multi-billion-dollar fight. On May 28, 2024, QXO made its move, dropping an unsolicited all-cash offer of $1 billion for RXO. This wasn't some whispered conversation in a boardroom, it was a very public declaration, sending a clear message to RXO's shareholders. The offer represented a 14% premium over RXO's 30-day average trading price. For some investors, a 14% premium might sound like a solid payday, especially if they've been holding the stock for a while. For others, particularly those who see long-term value, it might not move the needle enough. QXO, in its public statements, framed this bid as a strategic imperative to create the industry's highest quality and highest performing asset-light logistics company. It's an ambitious goal, especially considering RXO itself is no small player. Remember, RXO was spun off from XPO in 2022, specializing in brokered truckload transportation and crucial last-mile services. Think of them as the orchestrators behind moving goods, connecting shippers with truckers, and making sure that package gets to your doorstep, even if it's the last stop on a long route. The market's immediate reaction was, as you might expect, quite lively. RXO shares surged 13% right after QXO's offer hit the news, closing that day around $21.50. This surge reflects investor excitement, not necessarily that the deal will go through, but that there's a serious potential for a higher price or a bidding war. For an investor who bought RXO at, say, $19 a share before the offer, this bump could translate to a quick 13% gain if they sold into the excitement. However, RXO's board quickly weighed in, setting the stage for the next phase of this corporate drama. RXO, however, wasn't impressed. Less than 24 hours after QXO's public bid, on May 29, 2024, RXO's board unanimously rejected the $1 billion offer. Their statement was pretty blunt, stating the offer significantly undervalues RXO and is not in the best interest of its shareholders. Think about it like this. If you've been meticulously tending to a garden, knowing the fruits of your labor are just about to ripen, someone offering you a fraction of what you believe it's worth isn't going to cut it. RXO believes strongly in its own growth trajectory. They pointed to their strong fundamentals and long-term value creation opportunities as reasons for holding firm. And there's a fascinating wrinkle here: the potential conflict of interest. Remember, Brad Jacobs, the force behind QXO, was also the driving force behind XPO, which, as we discussed, spun off RXO in 2022. He essentially built the company he's now trying to acquire at what RXO views as a steep discount. This history likely fuels RXO's conviction that Jacobs knows exactly how much potential they hold, and that $1 billion simply doesn't reflect it. So, what's QXO's next move? This rejection opens up several possibilities. Will Jacobs and QXO sweeten the deal, perhaps offering a 20% or even 25% premium, pushing the bid closer to $1.1 billion or $1.2 billion? Or will they go hostile in a different way, taking their offer directly to RXO shareholders, bypassing the board entirely? Or will they retreat, deciding RXO's current valuation makes the acquisition too rich? The lesson here is that in hostile takeovers, the first rejection is rarely the last word. This fight isn't just about RXO, it also casts a significant shadow on XPO. For investors who might have been hoping for a quick, tidy resolution, this story gets even more interesting. RXO wasn't the only target QXO had in its sights. Buried in the filings, QXO also revealed a far more ambitious move. A non-binding offer for XPO Logistics itself, made around mid-May 2024, before the RXO bid became public. That's right, Brad Jacobs wasn't just coming for RXO, he was circling XPO, the company he built and then spun off, which currently holds a market capitalization of around $5 billion. The bigger picture here is QXO's ultimate goal: to recreate a dominant logistics player. Think of it as reassembling a very profitable puzzle. By acquiring both RXO and XPO, along with potentially other companies, Jacobs is looking to effectively rebuild his previous empire under the new QXO banner. This isn't just about growth, it's about strategic market consolidation. Imagine if in 2015, instead of expanding XPO, Jacobs had spun off a smaller company, then came back years later to buy both the original and the spin-off. That's the kind of complex, multi-part acquisition strategy we're seeing unfold. The sheer scale of this ambition is striking. XPO, with its $5 billion market cap, is a much larger beast to swallow than RXO's $1 billion. Acquiring both would be a monumental undertaking, signaling QXO's intent to become a truly formidable force in the transportation and logistics sector. The lesson here is that sometimes a corporate move isn't just about one transaction, it's part of a much larger, multifaceted strategy to reshape an entire industry. What's next? The billion-dollar chess game has only just begun. So, what's next in this billion-dollar chess game? For QXO, there are a couple of paths forward. Will Brad Jacobs sweeten the deal and make a higher bid for RXO? Or will we see him launch a full-blown proxy fight, trying to sway RXO shareholders directly by campaigning for their votes? Keep in mind, Jacobs has done this before. In 2011, when he acquired XPO, it was an equity shell with a market cap of only $150 million. His strategy then involved rapid-fire acquisitions and aggressive growth. The question now is how much more capital Apollo Global Management, QXO's financial backer, is willing to deploy for this ambitious plan. They've already committed significant funds. The market ramifications for the logistics sector are pretty significant. We could be looking at increased consolidation pressures, especially for smaller firms trying to compete with these newly formed behemoths. If QXO is successful, it would create a logistics giant, potentially forcing other companies to merge or be acquired to stay competitive. Think about the ripple effect. A major play like this from QXO could spark a wave of M&A activity across the entire industry. For XPO and RXO shareholders, this creates a fascinating dilemma. Do they hold out, hoping QXO comes back with an even better offer, perhaps a 20% premium over the current $28 per share bid for RXO? Or is QXO's current offer, representing a 14% premium over RXO's 30-day average, the best they can realistically expect? It's a classic balancing act between potential upside and the risk of the deal falling apart. The lesson here is that in these situations, understanding the underlying value of the company, not just the offer premium, becomes crucial. This battle for RXO and the potential for an XPO takeover isn't just an isolated event, it's a microcosm of a broader industry trend. We've seen a surge in serial acquisitions and private equity involvement in recent years, with firms like Apollo Global Management playing an increasingly central role in shaping corporate strategy. So, what we're really witnessing here isn't just a corporate battle over RXO and XPO, but a masterclass in strategic maneuvering by Brad Jacobs, attempting to engineer a new logistics superpower from the ground up, much like he did with XPO over a decade ago. The audacious nature of launching a hostile bid for RXO while simultaneously eyeing its former parent, XPO, is a testament to Jacobs' aggressive playbook. The lesson here is that even with well-established companies, the market can be disrupted by a determined and well-funded player, especially one with a track record of identifying and unlocking value. For investors watching this unfold, it highlights the significant premiums often paid in M&A, and what this means for someone in your situation is that understanding a company's fundamental value, beyond its daily stock price, becomes critical when a takeover bid is on the table. Now, I'm curious. If you were an RXO shareholder, looking at that 14% premium on their 30-day average, would you have pushed for the board to consider QXO's initial offer, or would you agree that it significantly undervalues RXO? Let me know your thoughts in the comments below. And if you want to understand how these high-stakes corporate power plays impact your portfolio, make sure to subscribe to the channel for more data-driven breakdowns. If you like this deep dive into hostile takeovers, then you absolutely need to watch my video on the 2022 rate hike cycle and how it affected company valuations across different sectors, because understanding that historical context is key to seeing the bigger picture in today's M&A landscape.